Now let us look at it from the perspective of the call option writer. That means what? That means let us understand when will the call option writer break even? When will the call option writer will make a profit, if at all he does any? And when will a call option writer start incurring losses? So these are the three questions that we need to answer, and let us understand again with the help of an example. So let us say the exercise price is 100. Amount of premium that he is getting from the buyer of the option, buyer of the call option, is rupees 100. So remember, break even will happen at the same point at which the break even was happening for the buyer of the option, and for the obvious reason, because the fact it is break even point, that means the buyer is neither making loss nor making any profit. So when the buyer of the call option is not making any profit or any loss, correspondingly the writer of the option will also not be making any profit or any loss at the break-even point. So which means in case of the writer of the call option also, the formula for break-even point is still the same. And what it is when the spot price is equal to exercise price plus the amount of premium, and it is at that point that even the writer of the option will also break even. And let us understand it with the help of an example further. So what you have five situations here. Number one, you have a spot price of 90, and then 100 and 110 and 120 and 130. So we have taken five different scenarios. Exercise price, obviously, as we all understand very clearly, is going to be same irrespective of what the spot price is. And likewise, the amount of premium also is going to be the same irrespective of what the exercise price is or what the spot price is, because premium is what he has already collected in advance. Now, this is a call option, and meaning what? Meaning a call option will benefit buyer of an option only when the spot price of the underlying is moving up. If the spot price of the underlying is going down, down even lower than the exercise price, in that case, the buyer of the call option doesn't stand to gain, and that means who stands to gain in that case? Obviously, it is the seller of the option or writer of the option who would stand to gain. And let us understand with this example. So what you have the exercise price of 100, and you have a spot price of 90. So remember, since the spot price is less than the exercise price, this at this spot price, this option is out of the money. This option is out of the money. Since this option is out of the money, obviously the buyer of the option is not going to exercise it. So what is going to happen? So you have the spot price, which is 90, minus the exercise price, which is minus 10, and then you minus the premium, and what you get is a profit of 10 rupees. You get a profit of 10 rupees. You get a profit of 10 rupees for the writer of the call option. When, let's see what happens when the spot price moves up to 100. अगर स्पॉट प्राइस 100 हो जाती है तो क्या होगा? तो स्पॉट प्राइस माइनस द एक्सरसाइज प्राइस माइनस द प्रीमियम, again some error. Okay, so now you have 100, which is the spot price, minus these two total. So 100 minus 110, you have a profit of 10 rupees. So really speaking, here the profit would have been 20 rupees, for the writer of the option. But remember, the maximum gain that the writer of the option can have is subject to the amount of the premium that he has collected. So the amount of premium that he has collected is 10, and therefore he is going to get a profit of rupees 10 only, even though this difference is coming to 20. Now, what happens when the break-even price is 110? So when the break-even price is, when the spot price is 110, so 110 minus the exercise price, which is 100, minus the premium also, which is 10, and what you get is a 0, and that means this is the break-even point. So अगर आप from the spot price, if you minus the exercise price, if you minus the premium, what you get a balance of 0, and that means this is the break-even point, and this is what it confirms, that for the writer of the call option as well as for the buyer of the call option, the break-even point is going to be spot price equal to exercise price plus the premium, and that is how it's going to be. Let's see what happens further. Now, if the spot price is increasing to 120, so 120 minus 100 is 20, and from 20 we minus the 10, which is the amount of premium, and then what is going to happen? He is going to incur a loss of rupees 10. And please remember, as we have discussed many times, as far as the writer of the option is concerned, it is very clear, and that is for the writer of the option, the profit potential is limited, which is limited to the extent of the amount of premium that he collects, but the potential for the loss is unlimited. As the stock price or the spot price of the underlying keeps going up, the quantum of loss to be suffered by the writer of the option also keeps going up. So let's look at this. So when the spot price becomes 130, so 130 minus the exercise price, which is 100, what you get is 30, and 30 minus 10, and you get 20. So now the loss of writer of the option is going to be 20. And if we can further stretch it, if the spot price is 140 and exercise price will remain same what it is, the amount of premium also will remain what it is. So 140 minus these two figures put together, and the writer of the option will suffer a loss of rupees 30. So what is the conclusion? Conclusion is, number one, the break-even is spot price equal to exercise price plus premium, and that is where the break-even is. What is the point of loss? That means when does he start incurring loss? So when the total of the exercise price and premium is lower than the spot price, or when the spot price is greater than the total of exercise price and the premium, and that is where a writer of the option will start incurring losses. What is the point of gain for him? The point of gain for him is opposite of point of loss. So when the spot price is lower than the total of exercise price and the premium, and that is where he is going to gain. But remember, his gain is going to be limited only to the extent of the amount of premium that he has collected. And why is that so? Please understand this also. Why is that his gain is limited to the extent of the amount of premium that he has collected? That is because the moment an option is not in the money, the buyer of the option or the holder of the option, call option, he is not going to exercise it. So if he does not exercise, really speaking, there is no profit happening to the writer of the option. The only gain that he gets is on account of the amount of the option premium that he has collected. So this is how we would understand it from the perspective of call option writer. I hope it makes sense to every one of you. Baman sir?
Sir, this is the best thing you have done.
Very good sir, very good. Pooja?
Because the same figure, no, we can remember it.
Yes, exactly sir, exactly. I have done it purposely so that for the same reason that you have mentioned, because if the numbers are same, then you do not have to make an effort to remember them. Pooja,
Right.
यस सर.
very good. Is it clear, Pooja? Totally.
यस सर,
Ve-
और क्लियर होता जा रहा है धीरे धीरे.
बहुत बढ़िया, बहुत बढ़िया. नो नो, आई एम श्योर पूजा, जैसे 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 आप और तैयारी करोगी आप एकदम परफेक्ट हो जाओगी. दिनेश.
Yes, sir.
ओके, एक्सेलेंट, एक्सेलेंट, वेरी गुड.